We're excited today to sort of talk through some of the things with the viewers on our development of our outlook and sort of the framework we use to develop our outlook. And one of the frameworks is sort of thinking through the known knowns, the things that are generally known that everyone knows and everyone assumes they know, the known unknowns, which are things that are known but the outcomes are not known perhaps, and the unknown unknowns, which nobody knows, and we sort of try to plan forward. You never know.
Yeah.
So maybe, Mike, we're going to talk through these in detail, but let's start with the known knowns and that framework. How do we grab those ideas and how do we assess them?
Yeah. Known knowns, another terminology for the known knowns are the consensus views. And that is a very important starting point because you're not just sort of playing the game, you're also playing the player when you're investing. So understanding what everybody thinks, what the consensus view is, and what everybody thinks is likely to happen is very important. There isn't a lot of value in investing in line with the consensus views. What's more important is understanding what everybody thinks is going to happen. Because if it doesn't, that's when you could have a serious disruption in markets that you need to be aware of. So that's the starting point. Going through and gathering what the consensus views are is very difficult. You would think it's just reading outlooks, but you have to parse through every single element of financial markets and look at prices and say, all right, well, if the 10-year treasury is trading at 94 basis points, what does that mean in terms of consensus expectations for economic growth, inflation, the Fed, global central banks, all of that? And so parsing that out is sort of the starting point of the process.
Yeah, that's great. That's a great way to illustrate it. So let's take that example of the consensus view on the 10-year treasury and where that sort of sits in terms of how we look at that. In our base case, I think we have the consensus estimate of a 1.25% on the 10-year treasury. So how did we arrive at that?
Yeah. So you start off with what is the market saying is consensus. And there you can't look at the current treasury yield. The current treasury yield is right around 1%. So what you can do is you can look out to the futures market. So literally, or what are people saying 1 year from now, 2 years, 3 years from now that the 10-year treasury yield is likely going to trade at, and are they willing to take the other side of that trade and you make a market? And so 1.25 is pretty close to the 1-year forward rate on the 10-year treasury. So that's important. Just look into forward-looking elements of the market. Then you can go through every economic forecast out there and get those consolidated, and you'll see there's a range, but generally they come out to somewhere around 1.25 to 1.5%. But then what's more important is what else is that implying? So the 10-year treasury at 1.25%, what that means to us in terms of gathering consensus views is everybody is expecting economic growth to recover somewhat next year. Estimates are in the range of +2 to +10% GDP growth. So the 10-year treasury yield should be higher if we're going to get strong economic growth like that. Consensus is inflation should be anywhere from 1.5% to 3% next year at times. So if that's the case, then the 10-year treasury yield consensus view should be much higher. So what that means to us is everyone is thinking the Fed is going to look past these things. And the Fed is not going to move at all. Regardless of how strong the economic recovery is, regardless of what inflation does, next year the Fed is going to look through it and not budge and not even thinking about raising rates. And so there we can go out into the Fed funds futures market and say, is that in line with expectations? Yes, that does seem to be consensus. But now we're talking about the 10-year treasury yield, not just the Fed funds rate, which is at the front end. So what other Fed activities could influence the 10-year? So now we're looking at consensus estimates for the size of the balance sheet. What is going to be the estimated pace of monthly purchases? And there we can see the consensus view is they're going to continue at their current pace, which means the balance sheet could reach $8 trillion next year, which is year-over-year growth of about 8%. And this is not just the Fed, it's every central bank. So, that was probably too long of an answer to the question, but you can see how nuanced just gathering the consensus is and how much information is baked into these estimates and also financial market prices. And all that goes into the starting point for the outlook.
Yeah, I don't think it's not too long of an answer. It just shows that there's more to it than just, as you said, reading outlooks and coming up with a number, pulling it out of a hat. So
Yeah.
let's roll through some of the other topics that we are evaluating for a 2021 outlook. So obviously the virus and the vaccine. So that's sort of the big one on the table. Let's tackle that one first.
Yeah, and the consensus view there, the tagline is rapidly approaching herd immunity. And the idea is based on the effectiveness of the Pfizer, Moderna, and even the AstraZeneca vaccines that as we approach Q2, that vaccines are going to be widely available for anyone who wants them, and that we should be rapidly approaching herd immunity at that point, at least in developed economies.
Right.
Most developed economies have purchased far more vaccine doses than they'll actually need based on the number of people who actually live in the country. So the consensus view is in April, we should be able to walk into a Walgreens and get a vaccine, or a CVS, not to name any one particular company, and get a vaccine if we want. That is the consensus view. So there isn't a lot of money to be made investing in line with that view. A lot of money could be made if you have a view different than that.
Right.
And then you have to ask yourself, do you have a view different than that? If you don't, then this isn't something that we need to spend more time on. We take it as fact and we monitor it, because if it doesn't evolve, then we would need to react from there.
And just let me pause there. There's always noise around those things. So, vaccine distribution isn't going as well as it should, or the effectiveness might not be as strong with some of the mutations. So talk about sort of the noise around the signal and how we think about that.
Yeah, the signal and the noise. So a perfect example would be there was news recently about the UK variant being far more contagious than other variants of the vaccine, of the virus, other strains of the virus that were going around. And, we met as a group and determined, hey, is this signal or is this noise? And ultimately determined this is noise. Why? Because what truly matters is, are the vaccines going to be effective, and are people going to take them that want to take them? And this variant in the UK was spreading like wildfire throughout the entire AstraZeneca and Pfizer trial process. And those vaccines still showed very effective. So that, in our view, was noise. Now, noise around a consensus view is also something you can make money from. If that noise was loud enough that it caused some of these reopening theme stocks to sell off dramatically, we would have viewed that as a buying opportunity, because the signal remained strong despite the noise.
Yeah, that's a great illustration of making sure you're always aware of what's happening around these key themes and trying not to get distracted by them. Mm-hmm. So let's move to another. We've talked a lot about the Fed, but let's move to another consensus view, which is consumer behavior, and walk us through what our thoughts are there.
Yeah, the consensus view there is, and the tagline is, I just want to go out and dance, is sort of the idea that consumers have money. They have quite a bit of money, and their balance sheets are healthy. So last year during the lockdown, they traded a lot of money that would have been spent on services and leisure activities, was substituted for durable goods purchases. And, renovating your patio is great. But by the time we get to next fall, if lockdown restrictions have been eased, there's probably going to be a re-swapping of consumer buying habits. Not necessarily away from durables, but I'm not going to redo my patio again. I'm going to go on vacation. I'm going to go get on a plane. I'm going to go to a hotel, go out to eat, etc. So it's, once again, there's signal and noise here. The signal from 2020 was there are a lot of trends that were accelerated in terms of consumer behavior. Things like moving out of large, densely populated areas, more out into suburbs, getting a bigger home, renovating your home, making sure you have Wi-Fi connectivity. That signal is probably going to stay strong. And that's probably not something you want to get in the way of. But you also have to realize that by the time we get to the back half of next year, you might have a pause in that trend. And we might have sort of a splurge of spending on leisure activities and things like that. And that's part of, kind of the reopening theme and how you can position your portfolio to benefit from that, certain stocks you would buy during the back half of the year.
Yeah, that's great. And the behavior of consumers, I think a lot of people think that consumers aren't financially strong right now. You hear the news of closing the wealth gap. So how do we reconcile that noise with the fact that consumer balance sheets are pretty strong?
Yeah. Well, the wealth and the income inequality has created a lot of variation in the data. And there are still going to be a number of have-nots. And with a Democratic Congress and a Democratic president, the hope is the have-nots will get all of the support that they need, and hopefully they can spend as well. But by and large, the majority of economic spending is done by the people that fortunately have more of the wealth and more of the income.
Mm-hmm.
So when you're talking about picking out the signal versus the noise, and you're trying to predict overall economic results, it's actually more important to start with what is going to be the behavior of the people that have the money to spend. So the wealth and income inequality generate a lot of noise around that. But if you're just worried about forecasting sort of high-level economic data points, you should really be focusing more on the folks that have the money to spend, fortunately, and we think they will spend it.
Yeah. So let's look at fiscal policy and the known knowns we've observed and used in our outlook development there.
Yeah. Fiscal policy tagline there could be no hawks left. It could also be too much too late. The conversation around the deficit has evolved quite a bit. We have the US government has spent beyond its means, and that's a known, and we were doing it 3 years ago. So what we did last year is sort of, we already crossed the Rubicon, and we're just hoping there are no long-term consequences. So there really isn't much of an appetite, and not just in the US, globally, to try to solve fiscal imbalances next year. The economy is too fragile. Nobody wants to disrupt the economic recovery. And also, politicians, a lot of them are kind of in a wait and see approach, say, hey, we can spend this money. If there are no long-term repercussions in terms of my currency or inflation, why would I stop?
Right.
There's a lot of momentum.
Right. Because the alternative is austerity or taxing, and those are not popular alternatives.
Yeah. If it's cut spending, raise taxes, or just think about this differently, path of least resistance is just think about it differently.
Mm-hmm.
And that's what's happening.
Right.
Ideas like modern monetary theory exemplify that.
Absolutely. Absolutely. So translate that to our known knowns around the monetary policy.
Yeah, known knowns around monetary policy is most central banks are in a position right now where their ability to stimulate the economy is almost gone. They can't lower interest rates anymore. And more academic research has come out to say that increasing the size of your balance sheet has little to no impact on economic growth. It has tremendous impact on asset price inflation. But most central banks look at their mandates, which are full employment and price stability, and they think, what can I really do at this point? I've been all in at the poker table for a year now. There's nothing more I can do. The best thing I can do is not disrupt financing on the fiscal side. The burden of stimulus next year is going to continue to fall on governments to provide fiscal aid, and they're likely to do that. And the best the central banks can do is say, let's keep the stock market quiet in the meantime. We don't need a stock market sell-off while the economy is recovering. We're trying to get everything back on track. So I will be as supportive as I need to there, market stability. And then when we need to roll over these massive amounts of government debt around the world, central banks will be there to make sure that everyone who needs to buy it, including themselves, can buy it, so governments can roll it over at a very low interest rate. There is no expectation of any major central bank hiking interest rates next year. And think about how far we've come. When we came out of 2008, there were so many concerns that we had pumped the economy full of too much stimulus, and the Fed's unprecedented actions during the global financial crisis would result in so much inflation that the Fed would have to rapidly increase interest rates in 2009 and 2010.
Oh, yeah. I remember those days.
Yeah. Nobody thinks that this time around.
No.
Nobody
Yeah,
thinks it's going to be
absolutely.
necessary.
Right. Yeah, and I think there's in a future edition of Uncapped, perhaps we can tackle the idea of what is the end game around all of that. But for now, for the foreseeable future, there is no course change or course correction that we see on the horizon. Right. So let's move on to corporate outlook, credit cycle. I mean, there are a large number. I don't even remember, maybe you know the number, but I don't remember the exact number, but there's a large number of zombie companies now in the S&P 500. So what's the outlook on the corporate side and the known knowns there and the consensus view?
The outlook there is that defaults will not be tolerated. Basically, if you are a corporation that was in decent financial standing, relatively speaking, decent financial standing prior to COVID-19, and you fall on tough times, that you will get the aid you need, either through the Fed or hopefully through fiscal stimulus. That is the hope. And obviously, it's much easier to get aid for larger companies, but the consensus view next year is that you probably won't have a lot of defaults because there is so much liquidity in the corporate bond markets, and it's so cheap for companies, even well below investment grade companies, to refinance their debt, that defaults are probably not going to be any higher or lower than they have been in prior years. In theory, even if you're a business with zero revenues or negative earnings and you have a debt maturity due, as long as you can borrow more money to pay off your existing debt load, you don't have to default. And that is the route of zombification. And that is more and more what's happening. So if you're a bondholder, that's great, right? I'm going to get my principal payment returned to me upon maturity, and I'm going to get coupon payments along the way. Bad news is if you buy one of those bonds, you're not going to get much in terms of coupon payments or much principal back at maturity because interest rates are so low. But that's sort of the consensus view right now.
Great. So let's shift gears to some of the unknown, the known unknowns related to some of these items. So first, perhaps the vaccine.
Yeah, and the known unknowns, another terminology for that is just the consensus questions. These are things everybody is on the top of everybody's mind, everybody's monitoring, but nobody really knows the answer to. So for the virus vaccine, things like how long will immunity last? Difficult to say. You could sort of gather that if the folks who started the trials, for example, the Moderna vaccine back in March and in the spring and summertime, they should be getting tested for antibodies regularly. And hopefully that'll give us some idea of how long immunity lasts. And hopefully we just need to get past the 12-month mark, right? If this turns into a flu shot scenario and you have to get it once a year, that's probably good enough news for the market and for the economy. So how long will immunity last? How quickly will the virus mutate? How quickly and materially? We know the virus is mutating. We've had at least 2 mutations per month on average since last fall, actually, since fall 2019, excuse me. So the virus will mutate, but we don't know if it will mutate enough that existing therapeutics and vaccines will become less effective. Known unknown. And then the idea is, what would have to happen in terms of the virus and vaccine to force another situation like March 2020, full lockdown? It's good that that's a known unknown. Nobody knows right now how bad it would have to get. It's not top of mind. It seems very far off.
Right.
Nobody knows that. That's that's coming towards unknown unknowns. And that's why, if that's your bear case, then you should assign a low probability to something like that going the wrong way.
And good news around those is we've dealt with this once. So if there's another lockdown, it shouldn't be as detrimental to economic growth and impacting, impacting all of the things it impacted initially. So, those are things you have to assess as well. So let's move on to the fiscal side. What are the potential unknowns there?
The biggest known unknown is, when will governments be forced to deal with runaway fiscal deficits? Will they do it this year? Will they do it next year? Will it morph into, will they just change their thought process and their checks and balances to the point where maybe they don't have to deal with these things? Those are the known unknowns there. Our view is it's probably not going to happen this year, might not even happen next year. Thinking around deficits and what's sustainable is evolving so rapidly, and so that's why we're going to dig more into that in future videos.
And in terms of central banks, known unknowns, obviously inflation. I think people fear inflation, but I think what we fear more is the rhetoric and response to inflation. That's what we should sort of, the unknown is. So maybe give us some perspective there.
Yeah, the immediate known unknown is if we get an inflation spike mid-year, the Fed has said they're not going to react to it. They're not going to hike rates. They're not going to shrink the balance sheet. They're going to view it as transitory. They're going to look through it. The known unknown is, will they actually do that? Especially if inflation hits 2.5%, 3%, especially if inflation is in essential goods that people need to buy. It can be difficult to do that as a central banker. So that's a known unknown. Will they react? How will they react to this spike in inflation that we're likely going to get in 2021? And then the other bigger known unknown is, does this have legs? Could we actually get a secular change in inflation dynamics going forward because of all of the money printing, because of talks about central banks going direct to consumers, bypassing the banking system and providing direct stimulus deposits into checking accounts? Things like that have never been done before. And we just don't know what the long-term consequences are there for inflation and for the value of currencies. And things like, the US dollar's reserve currency status. Those are huge known unknowns.
Right. Yeah, that's another big topic for an uncapped session. So what about the consumer side? What are the known unknowns we're looking at there?
One of the biggest known unknowns is, will consumers who stayed at home, saved money, and in many instances invested in the stock market and made a lot of money, take that money out of financial assets to finance purchases?
Right.
Will they basically, a lot of consumers got actually a big jolt of income last year through the stimulus, probably going to just got another one and probably going to get another one after inauguration. But if you get used to having that much money in your checking account, you get used to those income boosts and wages start to stagnate if you're fortunate enough to have your job. Do you start to subsidize that by selling financial assets? So could there be a transfer from financial wealth back into the economy in 2021? That's a big known unknown. You would think that doesn't sound so bad. For the economy, it's probably not a bad thing, but for the stock market, that's a bad thing. Selling is bad. So that's definitely a big known unknown. And then also, there are so many companies whose business models seemingly, were almost extinct from COVID. You look at just some brick and mortar retailers, for example, and the argument is that those are dead money stocks. But an environment like that can also be a catalyst for fundamental long-term change,
right?
Long-term improvement in a business and how they're going to market to consumers and provide their products. And so the known unknown there is, do you have these beaten down companies that are beaten down through the pandemic? Have they actually taken steps during the last year that actually increase their long-term value? So they're cheap right now, and you're telling me their long-term valuation should be higher. That's a huge opportunity. You compare that to some companies that benefited from this pandemic, can you make an argument that they just took future very lofty growth expectations and just pulled them into the present, and therefore the long-term value actually shouldn't be any higher? So why am I paying the most I've ever paid?
Or could be lower. Yeah.
Yes.
Yeah.
Yeah. So how the market deals with that valuation phenomenon is going to be very important.
And we've
for
seen
next
some
year.
of that in terms of the sort of the seed sprouting of the shift from growth to value that's
Yes,
taken place. So that's
exactly.
something the big theme of ours for 2021 to continue. Let's just finish up with the corporate side of this and the economic cycle itself, and what are some of the known unknowns there?
Yeah, the known unknown there is, you look back at the economic data through COVID, and yes, it was bad, but it actually wasn't as bad as expected. Could have been far worse. And also that these numbers from 2020 are going to be revised. A lot of the big headline numbers continue to be revised. And so there's an expectation that in 2021, you're going to get this huge recovery in economic growth because you're coming off of such a low base. It's going to be so easy to beat these year-over-year comparisons and economic growth figures. But what if last year's number gets revised up and it turns out last year wasn't as bad and therefore next year isn't as good? Adjustment of expectations. So that's a big known unknown. Was it really as bad as we thought? And therefore, if it wasn't, then next year isn't going to be as good as people think.
Right.
There's that. And then also you look at a bunch of a large number of businesses that provided essential products and goods, and COVID was just a boom time for them. How can they possibly beat these year-over-year expectations?
Right.
You look at a business like you take some home improvement stores, and such a windfall of demand in such a short period of time. And there's probably a long-term trend of people continuing to move out away from cities and into houses and redoing their homes and improving that you want to be in line with. But, can you possibly top March and April 2020 next year? When you're one of those businesses? So that's a big known unknown. Are the expectations just far too high?
Right. Absolutely. Well, that's some good perspective on the things that we consider the unknown unknowns. Maybe just finish those. Those are things we just kick around, continuously in our discussions. But you never know what's going to happen and how things can play out. And we didn't know COVID was going to happen, and that was definitely something not on our radar screen. But take us through the process that we use internally to think about those types of things.
The unknown, you almost don't even know when you're saying one, but it's usually you sound kind of crazy when you come up with one. So for example, you could say an unknown in June, July of 2019 was we're going to have a global pandemic that brings the entire global economy to its knees in about 31 days. And you would say that, and you'd say, well, if I were to position my portfolio for that now, I would basically have to sit all in cash. So you would be sitting in cash from summer 2019 through at least March 2020. And you would have to know when to get back in. If that unknown actually played out, it's two trades. You have to go to cash first, and then you need to know when to reinvest. So that's why these unknown unknowns, you can kick them around, but at the end of the day, they're generally such low probability events, and they're so impactful that if you were to actually position your portfolio for one of them and you were wrong, it would potentially be catastrophic for your long-term outcomes. It's
Right.
not worth necessarily preparing for. So it's far better to sort of take these unknowns as they come. These things happen every once in a while, and just think, all right, now that the game has changed, what's my best course of action from here? Pandemic happened. We're in the depths of March. We're going to get the biggest fiscal stimulus package we've ever seen, and central banks are rapidly increasing their balance sheet. Now I feel comfortable buying stocks. I'm just going to sort of take this one as it comes and focus on the next play. So that's how we deal with those.
Yeah, it's always a fun exercise to go through those types of discussions. So thanks for watching, and we appreciate everyone's input on the client side to these outlooks, and we look forward to a great 2021.